I'm Alec Hogg from biznews.com, and it's really nice to be talking with Sean Peche. Quite a big day, Sean, on all kinds of fronts. Piece in the Wall Street Journal this morning saying that the value investors, i.e., you and your group, are very excited about the fact that value is likely to outperform growth by more than any other year since 2001. That's first point. Second point was to see Naspers listening to what you told him to do last time around, or certainly the issues that you've been raising. But maybe let's start off with a Naspers story, because it's just come out. Share price up 15%, Naspers stroke Prosus, unlocking value for shareholders, getting rid of this lockup that they've had on Tencent shares. It seems to be very sensible.
You know, Alec, I'm actually delighted. And I did an interview with Justin from Biz News back in Feb, and I watched it again recently, and I was visibly frustrated, almost to the point where I was a bit embarrassed about how frustrated I was. But I was just so angry at the shareholder destruction I was witnessing, and the fact that this management team was being paid billions, and at the time I'd calculated was denying South African savers some 420 billion. And the problem is, you know, and I'm maybe some people, in fact, I received a couple of comments from some guys saying, why are you wasting your time why are you spending all your time, berating Naspers? And it's not that I have anything personal against them. I just hate injustice. And of course, during COVID, people were redeeming savings and retiring and all of that. And so to have that happening at a time when management are getting paid a lot of money and there's a huge discount really was red rag to the bull. And so, look, I actually publicly derided them in Feb, saying it's a technology business. And yet on their website, they've got an NAV back in September, and most of the assets are listed. So why have we not got a real-time NAV? Well, I looked this morning and I see there's an NAV at the 24th of June. So that's great. And hopefully my comments and notes over the year and the platform that Biz News has really provided me to make many of those has helped unlock value for SA savers. Because I guess, I like to feel my wife's a doctor, and I think social contribution is important. And my contribution can't just be running around a table and hoping some falls off. And if we can help allocate capital efficiently and help savers get the best, then that's great. So look, it's great news. They've sold their JD.com stake in JD.com for $4 billion. And I think I'm delighted, because that's a $100 billion business that made $1 billion last year. And people think they're going to make 2.5 this year. And well, good luck with that. So that's great. And and they've now committed to selling Tencent. And I did say in Feb as well that what I didn't understand is, if you're going to buy back stock, why show your hand? Because I was critical in that they seem to have been a huge percentage of the daily trade. And as soon as their buyback ended, the stock collapsed. And so, I said, if a sensible person is going to buy back stock, you don't show your hand. And so they have said, look, it's open-ended. We're going to sell small numbers of Tencent shares over time. And so that's perfect. That's what I would recommend. And look, maybe they've figured out that this growth illusion that Tencent's been on has been shattered, and maybe the tech pullback, I think the growth index down 27% year to date, has sort of jolted them into action, that this growth is not going to go on forever. Tencent's had declining EPS for the last 3 quarters year on year, and the stock's still at 26 times earnings. So I'd sell every dollar I could at those numbers. But definitely a move in the right direction. And now if they can stop wasting the proceeds on Delivery Hero and some of these other things, and just use the money to buy back stock. And when they're finished, actually in that other interview that I did with Justin, I had a second idea, which was to start a Tencent in South Africa. Start a venture capital business in South Africa and use some of these proceeds to solve some of the solutions, the energy solutions and all the rest. As I said, there's an energy crisis, but there's wind and there's sun in South Africa. So let's do that and get the economy going. But I'm delighted. I don't have any positions and all the rest, but that's fine.
Well, it's a pity you don't, because today the share price is up very strongly. In fact, you could have got the shares at about 15,000 Rand a share, and they're now heading towards 20,000 Rand a share. I'm talking about the Naspers one. So it's been I guess we all should be kicking ourselves that we didn't, or that we didn't bet that management's eyes would be opened, and they certainly have. Those scales have certainly gone from the eyes, and give credit where it's due. They haven't bloody-mindedly said, no, we're going to carry on a path that was destroying value. They've actually been listening. And today was big news there, Sean. But
Great
really,
news.
that other big story about value shares, and you are a value investor. I love the description that I heard that a value share is a company which trades at a low multiple of its book value or its net worth. Would you agree with that?
No, not necessarily. I mean, maybe that's in some cases that's the case. A value share is something where it just makes sound financial sense that, and the odds on your side that you're going to get a decent real rate of return. And the problem with this whole value growth, it implies that as soon as something is not growing, it's cheap. And that's not always the case. I mean, the worst shares in the world are companies that have stopped growing, which are expensive. You don't want to go near those things. And so I was horrified to see last week that Meta and PayPal and Netflix are now making it into the value index, especially since value index is not my benchmark. But I mean, those companies are still, I would argue, expensive, but they're not growing. And we want growing companies, but we don't want to pay too much for them. And we're just trying to act, I mean, the way in which we manage money is just act in a way that a sensible business person would act. And I say that you might want a decent, you might want a BMW. It's a great car, but at $2 million, it's not a great car. It's not a good buy. So that's it. You want a good car at a good price, and that's all we try and do.
Sean, I think we might be on different areas of the investment argument on Meta, but on Netflix, I'd love to get more of an insight from you there. You've been right on this one. You were warning us for months now about it. The fact that it's not growing anymore and has is become a value stock. Are you saying that the Russell guys are looking at the wrong numbers here?
Look, what they do is they take the index, they take the index and they segment it. And for value, they look at a price to book, but it's not tangible book. Okay, so a company that's been on a massive acquisition trail and got goodwill all over their balance sheet, like Disney, it might look like it's a low price to book, but it's not tangible book. So that's the first thing. And then they look at IBER's forward earnings estimates, which is it's like an analyst consensus thing, and they look at historical sales per share growth. So they basically segment it, and if the fastest growers go in the growth bucket, the slowest growers go in the value bucket, and sometimes there's a bit of a mix of the two, and so sometimes you get some shares in both. And but that implies that if you're not growing, you're cheap, and that's the problem I have with this, is that that's not necessarily the case. And actually, if that is the case, those are the worst examples. And look, on the face of it, some of these companies look cheap because the PE multiple is lower than what it was. But I mean, to give you an idea, Meta's market cap. I mean, Meta's it's entered the value index at number 5. It's above Chevron, and it's a $460 billion company, and they estimate it to make 37 billion. That's not an insignificant number. If you look at Netflix, it's a $85 billion company. Well, BP is only 90 billion, and BP's going to make 21 billion supposedly this year, and Netflix is going to make 4.5. So BP's net income of 21 billion is almost Netflix's revenue. So so the PE numbers are only cheap if those numbers play out. If Meta comes out next week, or a couple of weeks' time, we've sort of a few weeks' time away from earnings estimates, and the earnings are not as expected, well, then it's not going to be cheap. I mean, 2 years ago it made half. I think I'm right in saying, 2 years ago they made half of what they made, so the 37 billion. So if they just go back to earning what they earned 2 years ago, it's on 24 times earnings, which is not cheap. So it all comes down to the earnings, and there's a lot of movement in this advertising space right now.
It's so
I
interesting
don't
when you talk about Meta, because Meta themselves, and I did meet with two of the top 5 guys at Meta in Davos. It was a small little group of us,
Okay.
three others and myself, and they were saying they're betting the farm on virtual reality, which they see as the next big thing, as being in the early stages of the internet. So that, to me, that's an exponential company. It's a company you're investing in. If you believe virtual reality is the next big thing, then you're fine. But to see it in a value stock index does seem very, very strange, because when you're investing in the future, that's not a value stock, is it?
Oh, it can be. I mean,
Hmm.
the interesting thing, just to touch on that metaverse, is this is unproven. How are they going to monetize it? That's the first thing. Are they going to be able to? So they're going to invest a lot of money. We don't know whether they're going to monetize it, and they're not the only people going after that space. You've got Nvidia, and you're up against some other big guys, and so we'll have to see. But no, I mean, we've owned Google in our portfolio. In 2017, it was the largest holding because I could buy Google for less than I could buy Procter and Gamble. So I had a growth company, but I wasn't paying too much for it.
Got it.
That's the difference. So it all comes down to value. We all want nice houses and nice cars and all the rest, but we don't want to pay too much for them. And so that's the angle we go at.
It seems a bit simplistic. These earmarking. This is a value stock. This is a growth stock. But overall, though, the kind of shares that you invest in, the ones where you don't pay too much for the
Yeah.
projections into the future, are the ones that have underperformed for a long time and are now looking to significantly outperform. What's changed? What's happened?
Well, what's changed? So a couple of things. I mean, the speculation has gone out of the market, and we've had, and the reason value's underperformed is because we've had lots of expensive things in our index, like Coinbase and Tesla and Netflix and PayPal. I mean, PayPal is down 75% and its market cap's 90 billion. The CFO left and went off to Walmart, so it just shows you how high it was, and they did some crazy deals. In fact, I'm writing an article about one of them at the moment. And so what has changed is all of a sudden interest rates have gone up. You've got inflation, you've got interest rates going up. And so your $100, if you, for a growth company, if you're earning $100 in 10 years' time at 0% discount rate, that $100 worth 100. But at a 5% discount rate, only 5% per annum, that $100 in 10 years in real terms is only worth 61. So you can see a small movement in rates means a big discount in the actual, well, you should only pay 61 today, not 100. That's a 40% discount. And so that's, I think that's the main thing that's happened, that in an inflationary environment where people are not getting real returns, it was all very well going and buying some of these companies on 2% dividend yields when interest rates were, and when inflation was so low. But now inflation's 8.5%. Who wants a 2% dividend yield? So it has to come back to growth in earnings and all that. If you're not going to get your yield in the bond market, your real yield in the bond market, maybe you get it in equities, but then you're not going to get it in companies with only a 2% dividend yield. And so that's the all of a sudden people have sort of said, well, this doesn't really make sense. Let's go and buy these other companies. I mean, just another interesting point, Alec. The largest constituent in the value index is Berkshire Hathaway. The largest constituent in the growth index is Apple, but a big chunk of Berkshire Hathaway's value is Apple. But the difference is so this is what's so ridiculous about it. Why is Berkshire Hathaway in the value index? Well, it's low price to book. But what is its book? Its book is the market cap of Apple. What's Apple's book? It's computers and servers and things. But actually, do you see what I mean? So it doesn't
Yeah.
really make a lot of sense. And that's what I think, I'm trying to bring to light. And that's why I'm saying that sometimes this passive investing, one needs to look beyond that and say, well, but does this make sense? And just invest in something that makes sense, makes
And so
financial sense.
you've been in the UK a long time, Sean, because you're calling it Berkshire. Warren calls it
Oh,
Berkshire. But your county is called Berkshire, isn't it?
it
If
is.
you
Yes,
told
that's quite
people
right.
Berkshire, they'd be pretty upset with you. But hearing from a South African point of view, and we can hear that you might have been there for a couple of decades in the UK, but you're still very South African. There's an interesting point to see that the metals on which South Africa really depends heavily, some of them have now pulled back into a bear market, whereas the S&P last week, and it's difficult to make assumptions on what happens in 1 week, but it was such a significant increase that must we read much into this, and particularly from a South African point of view, where we are so vulnerable to the commodity cycle.
Yeah, last week was a big week. I mean, I think the S&P rose just under 7%. Interestingly, the world index is still down 6% for the month. So, so what happened last week? Well, I'm sure you had sentiment was very bearish. You had Chairman Powell testifying at the banking committee saying, we committed to bringing inflation down. But there's an interesting, so just to take a step back, on the 8th of June, like we had there was a fire at a LNG export terminal in the States. Now, you'll know that we've got a big energy crisis here. We're trying to wean ourselves of Russian gas. What does that mean? It means we need to import US gas. And so we're importing as much as we can. All of a sudden, you get a fire at one of the terminals, which exports 17% of US gas. And so you can see the traders going, well, hang on, if they can't export gas, the local market in the US is going to be overwhelmed. And so the natural gas price, fell in a heap. And so oil pulled back as well. And then you had a situation, people going, well, hang on, if oil's pulled back and natural gas is pulled back and some of these commodities are pulled back, maybe this inflation is going to moderate. And if inflation moderates, maybe the Fed doesn't have to raise rates. And if the Fed doesn't have to raise rates, let's go back to the races.
Wow.
Okay. You can see how the dots
Mm,
have been
mm.
joined. I think that's very simplistic, to be honest. I think this natural gas thing is temporary. Even if natural gas stays here after it's pulled back, it's up 114% year on year. Oil's up 64. The 30-year bond mortgage or 30-year mortgage is up 86%, that rate. Gasoline's up 81% and maize is up 53%. So that just gives you a flavor that the inflation based on natural gas, a temporary fall in the natural gas price for a couple of days. Okay, that's going to take a couple of months to sort out the fire, to repair the damage, but it is not over. And the S&P did enter a bear market, and I think at the lows we were down 25% from the highs. If the bear market's over, that's lasted 7 days. I mean, in 2020, it lasted 18 days. The average is about 10 months, so 290 days. Okay, so it'll be one of the shortest lived bear markets in history. But I think if you look at historically, half of the biggest days happen during bear markets, and bear markets do not occupy half of the time in the market. So you get these big moves. And in what traders talk about is, in a bull market, you buy the dips. In a bear market, you sell the rallies. Okay, but the problem is, what happens is people have lost so much money that as soon as it bounces, they go, "Good, thank goodness for that. Let's hold on a little bit longer. Maybe there's a bit more money on the table." And boom, the next hit happens. And before you know it, you're back in the bear pit. So, these little rallies, I think people should just be realistic about them. And that would be, and use them as opportunities to reposition for the future, because
So,
the future's going to be different.
so you not of the belief that the worst is behind us, and I want to pose this in the context of Howard Marks, who I'm sure you have respect for, as many people do, saying that he's turned into a buyer. He's buying aggressively again. It was all over the FT. Did an interview with him,
Correct.
presumably yesterday. Um, how do those two square up?
Well, look, I had a lot more respect for Howard Marks before he bought Bitcoin at the top after spending lockdown with his son. But he's a bond investor.
Uh-huh. Okay.
So no, I mean, I say that tongue in cheek. He's a very smart guy, and I really like his books. And the one thing I often look at, and I think of him regularly, he likes to talk about second level thinking. Don't just do first level thinking. That's what everybody else is out there. Think about the second level. So I credit Howard Marks for opening my eyes to that one. So take what I said in jest. First of all, he's a bond investor, so he's talking from bond perspective. And these poor guys have been starved of anything, of any yield in recent years. I'm an equity investor, and I would look at this week's going to be interesting. We've got Nike, H&M, we've got Micron, so we've got a couple of companies who don't have the traditional quarter year in a quarter, 3 months, and their quarters don't end in March, and I think they probably end in Feb or so. May. So we're going to have the quarterly reporting starting mid-July. And the multinationals have got huge currency headwinds. The euro and sterling is down 12% year over year. If you are a US multinational, you've got 50% of your revenue offshore. That's a 6% revenue headwind, plus the fact that your head office costs are in dollars, so you're getting squeezed on the operating leverage. So that's the first point. The yen's down 18%. You've got a weaker consumer. You've got inflationary pressures which have there's a lag between they finally flow through and hit the consumer, because the first people who battle the inflation are the wholesalers, and then they try and pass it on to the retailers, but the retailers push back until all wholesalers and all producers are passing them on. And then they finally make their way through. So, and you've still got high PEs on high earnings in many of these companies. So I would argue that Q2 earnings are going to be really challenging. And if I was the CFO of one of these companies, I'd be very cautious about, maybe you make the Q2 earnings, but what about your guidance? You're looking out here in a very different time, different place. And maybe that's why, who knows? But the CFO of PayPal left, and he left to go to Walmart. Now, that's after PayPal's down 75%. If I was working for a company and I thought this was the best thing and I was going to make an absolute fortune from this point, would I really leave and go and work at a retailer? Probably not. So I think that it's going to be really challenging, and I think everybody's invested in the US. And the other point I'd make is, and this is an important point, and I'm amazed I don't see more people talking about this, but these currency headwinds that these US companies are facing are tailwinds for European and Japanese companies. And everybody's underweight those. I mean, people have got 70% in the US, that's the benchmark. And I mean, the Japanese weighting, I think, 6%. And Europe, the whole of Europe's 20, and everyone's going, oh my goodness, yeah, but Europe's got a war and all the rest. Well, how's this for and you've got energy crisis? Well, do you know that France, about 70% of their energy is produced by nuclear? So and interestingly, last week, just to give you a flavor, if there's all this recession concern, everybody's talking about a recession, but it's mainly they're talking about a recession in the US. Well, we're probably going to have a recession elsewhere in the world, including here in Europe. But I was intrigued that BNP, the French bank, there was talk that they're sniffing around buying ABN AMRO. Now, that was great news for us because we own ABN AMRO and we think it's cheap. But if these banks were really concerned about a recession on the horizon, would they be out there? Wouldn't they be battening down the hatches, and rather than being out there, looking at snapping up undervalued competitors or peers? And you look at BNP; they sold their US bank, Bank West, to Bank Montreal in December last year at 1.7 times book. They're buying back their stock at 50 cents in the dollar, and they're looking at buying maybe ABN AMRO at 50 cents in the dollar. And so you go, well, I can go buy these European companies that are really knocked down, that everybody thinks the world's going to fall apart when they've got currency tailwinds, or I can go buy the overpriced stuff in the US. So that's where I think the opportunities are. And that's how we position.
Rational thinking. Sean Peche of Randmore Funds. I'm Alec Hogg from biznews.com.